First of all, thank you, Hans, for that kind introduction. And thank you to Terrapin for the opportunity to meet with all of you today. It's a pleasure to be here, and good morning to all of you as well. And I'm happy to say that the sun is out. Being an American but living here, I got to tell you, at first I wasn't sure what I was looking at this morning when I saw it. It's kind of a rare opportunity, so you have to really appreciate it and when it does come out. And now I understand why, when it does happen, every Brit in the world goes outside, no matter what the temperature is, just to be in the sun. So cheers to all of you. In any event, I'm going to speak today to kind of a very specific area, and within the exchange space, I think I'd like to ask your forgiveness if you're not on the derivative side, but I'm really going to be addressing all of us in total and derivatives and my band of brothers in derivatives specifically. So if you'll bear with me on that. Those of us in this room know it's a critical time for the global financial markets. The U.S. is climbing out of a recession while the deficit overhangs the economy, injecting uncertainty into the sustainability of that recovery. In Europe, we continue to seek answers to the fiscal crisis here, and that seems to be an ongoing saga that's been lasting, same in the United States, for a couple of years. In addition, we're starting to see a slight downturn within the BRIC economies, which has been a driver of global activity over the past few years. Add to that, the financial markets have had their share of issues as well over the last year, whether stemming from the LIBOR scandal, global regulatory uncertainty, as well as market infrastructure developments that we have not previously experienced and witnessed, and I'm sure we're speaking about here during the high-frequency sessions that we have in the panels here later today. Without a doubt, we find ourselves in a challenging economic and regulatory environment. Everyone's been affected by various global economic challenges that have existed post the Lehman crisis. The regulatory environment is a dominant environment on a global basis, but certainly within the United States and Europe, it has been front and center as far as focus for any exchange in the space. Match that with the technological challenges and the waning trust in our industry brought on by dubious activity and even outright fraud. And you can begin to understand the new environment for trading as well as for clearing and their roles going forward in the marketplace. I want to start today by discussing something that is at the center of all this. Why there's a need for confidence in the marketplace. Why does it matter to an asset manager in London or a farmer in the Midwestern United States that China's economy is slowing down? Why do market participants seek technology to trade faster, even though we've experienced speed bumps in some of the equity markets? The answer to all these questions is risk management and the economic benefits that this provides. Every business faces risk. We all recognize this very simple and plain fact. For an energy company or a hedge fund, the risks may appear quite different. However, at the end of the day, they are the same. At the core, those businesses and others face the same dilemma: the risk of losing income and or profits due to either loss of value, operational disruptions, or increases in input costs. Derivatives markets are a critical tool in price discovery as well as risk management for asset managers, hedge funds, farmers, and many other kinds of investors. We need to look no further than their wide acceptance and use on an international scale by institutions of all kinds. CME Group has focused its products and services division on the customer. In order to effectively accomplish this, we've created exclusive teams focused on banking, intermediaries, commercials, proprietary trading firms, hedge funds, and asset managers. According to the International Swap Dealers Association, 92% of the world's 500 largest corporations have reported making some use of derivatives, including futures and options such as those offered at CME Group. More than 90% took advantage of derivatives to manage interest rate risk. 85% reported using derivatives to manage currency risk, and 25% accessed derivatives to manage commodity price risk. Moreover, academics widely believe that the corporate use of derivatives generally works to increase shareholder wealth. That's a bit of a new twist when we're looking at this, because the accumulation of capital, the accumulation of wealth has always been prescribed to the underlying markets. Now, due to the risks that we are all facing and the corporate world is all facing, the accumulation of wealth is transpiring into the derivative market, which I believe is a very new phenomenon. By helping countless businesses and investors manage the risk, the benefits of the derivatives markets are linked directly and indirectly to economic growth. In last year's presidential campaign, much of the discussion focused on which candidate and which political party would grow the U.S. economy more. I guess we know the answer to that now. None. In countries across Europe, too, we've seen recent elections where there was plenty of debate about which candidate would be best for the long-term economic prospects of a nation. And without question, government does have a role to play in the state of any economy anywhere in the world. But there's something that is far greater in influence over a business's ability to hire workers and grow than which political coalition is in power. And that is a business's ability to manage its risk, to control costs, and to be able to invest in the future. When successful in these efforts, one important result is the ability to hire more employees, a dilemma that's affecting everyone in Europe as well as in the United States right now, and to keep our economies moving. But, of course, there are many other results as well. By managing risk properly, airlines can better control their fuel costs. Farmers can manage their input costs, which may allow them to plant more crops. Banks can lend to more businesses, farmers, and institutions. And that is a very, very important aspect of our markets today. The evaporation of credit being applied to the marketplace, the higher input costs while we had a complete destruction of production in the United States, which still functions as the breadbasket to the world. It's critical that risk management take a step forward and we be confident about it and we reassert the confidence in that market with our clients. The elections in Greece last May provided an example. After the results of the May 6 election, where power was splintered amongst several parties, political parties, the euro's value against the US dollar fell for 7 consecutive days. This affected any company doing business in Europe. The availability of derivatives allow businesses around the world to lock in value of the euro for a lower cost of goods than they might have shipped in the future. Other companies could, in turn, lock in the euro's value before it fell even further. And it doesn't just apply to agricultural commodities. Any company that depends on the use of materials or instruments with fluctuating prices benefits from managing their risk. And that's exactly what derivatives markets allow companies to do. That's what many of you in this room allow your clients to do. That's the service that you provide. That's what your customers demand of you, and that's what you have to deliver. And when companies can manage the risks associated with unexpected but inevitable events, it's not just the individual or the corporate that thrives. The economic health of nations is helped considerably by an industry's ability to keep itself afloat in even the most turbulent of times. Now, the examples I gave, how markets can help companies manage macroeconomic and geopolitical events, came from the U.S. and Europe. Established economies, which have long known the benefits of financial exchanges. My company, CME Group, was established in 1848 as a place to provide fair and transparent prices for grain and other commodities. I stated at the outset it is not the U.S. or Europe or Japan or Hong Kong that have been driving growth in recent years. It is these emerging markets like China, India, and Brazil, BRICS, and more recently, countries like Mexico and Indonesia. The epicenter of global economic growth and activity has been shifting from the developed nations to the emerging economies, with emerging markets experiencing accelerated growth through the developed markets via product or technology sharing, as well as organizational skills that they can accumulate from those developed markets. Economic growth in emerging markets has been driven by fundamental productivity of these nations. Vast populations resulting in strong advances in their GDPs. This trend has resulted in an international reallocation of resources from the developed to the emerging market economies. Capital and commodities flow across political and geographic boundaries with reasonable ease. However, as a cautionary note, this is not always the case within the emerging market sector. Emerging market economies have accumulated large stores of foreign reserves, most denominated in U.S. dollars, and invested in treasuries. Thus, emerging market policymakers call for fiscal restraint on the part of the developed economies in order to protect those investments. But developed market policymakers are faced with slow growth and high unemployment. Thus, policymakers implement loose monetary and spending policies in response. In other words, the divergence is starting to happen, and it's become self-preservation from an economic perspective. So there are now conflicting demands from emerging and developed markets, not to mention that they are increasingly competing for the same commodities. Please remember that. That's going to come back in this talk, and that is critical to what we're speaking about. Technology and transportation are going to play a large role in the global reallocation of assets. As middle classes in countries like China and India continue to grow, how do we enhance the efficiency of the farming industry and grow the food supply? How do we ship oil and natural gas across continents and across oceans more efficiently? But underpinning those issues is the role of exchanges. The emerging countries with a strong growing system of financial exchanges, and the government leadership who provide the right environment for those exchanges to flourish. We'll find the answers to these questions, and they'll find the benefits to continued growth. Some of the fastest growing economies in the last decade have been helped along by a healthy exchange environment. Brazil and their BM&F-Bovespa exchange is a good example. Its benchmark Ibovespa contract, which is a stock index, has increased nearly 500% since 2003. And it is a country with an advanced regulatory framework. Some might say a little too advanced when you look at some of the regs in terms of capital movement going in and out of Brazil. Though some of the country's growth has slowed lately, there are factors that have continued to attract foreign investment. Overall, exchanges in developing economies lead to better stability in underlying markets, better price discovery, less dependency on government controls, economies more reflective of supply and demand, and better infrastructure development. Let me give you one quick example on part of that, especially when it comes to less dependency on government controls. When we hit a wheat crisis back in 2007, limits were put on prices in the United States, down in Brazil. Over 33 countries put on tariffs, either prohibiting exports or inhibiting imports, in order to be protective within their own economies of the prices that they had. The net result, they inhibited and took supply off the market, and prices continue to escalate. It's just a fundamental misunderstanding of what happens in supply and demand and what happens when you turn that spigot and put the choke onto it. On this last point, India provides an example of where a more developed market environment can help. India has seen better than an 8% GDP for most of the last decade, yet it still suffers from a completely inadequate infrastructure. As high as 60% of India's crops spoil before they reach the market. Think about that number. You raise your crops, and 60% of what you send to the market never even makes it to the market. And we wonder why we can't feed Africa. The Wall Street Journal recently wrote that in the world of perishable goods, India has few rivals. The good news is that this presents more opportunity for growth. Odd as it sounds, it does. In fact, the country's chief economic advisor told CME Group's Global Financial Leadership Conference in November that infrastructure is the biggest opportunity in India for foreign investment. I would expect that capital flow to continue to move in. I would expect all of us to be part of that as we begin to further develop, work, and enhance with our partners in India their economic model, their exchange models, so as to provide a complete infrastructure that allows for that 60% to come down to a more normal level for what we would consider to be as close to a developed country as possible. It's largely because of the changing economic landscape and the opportunities in less developed markets that my company, the CME Group, last year announced that we've applied to the FSA to create a London-based derivatives exchange entitled CME Europe. It's a very, very vast departure from CME Group, which has been, you could say, U.S.-centric in its rules, in its fees, in its products. It's moving out to the world away from or enhancing our strategy of strategic relationships, which we've pursued for the last 5 years on a global basis. As the head of this new exchange, I can tell you that we're excited about the opportunities in underserved and underdeveloped markets. And we look forward to aligning more closely with market users in Asia, Europe, Middle East, and Africa. We expect CME Europe to open in mid-2013, pending regulatory approval, with a full suite of FX products, which we plan to expand into a multi-class product offering over time as we develop new product that is germane to the area that we're focused on and bring new product for price discovery and risk management to those areas. Exchanges today must seek to have a global footprint, but it's more than that. The examples I spoke of earlier with the drought and Greek elections, these have applications in developing economies too. Through effective risk management, firms in these countries or looking to invest in these countries have an avenue to provide better infrastructure, help to create jobs, and to make efficient storing and distributing of commodities a reality. For our part, we're committed to providing the scalability and the leverage of our developed technology and regulatory platforms to market participants looking to access those new markets. This includes CME Clearing Europe, our clearing solution for customers to take advantage of the UK regulatory environment, the law, and the time zone. CME CE provides a European clearinghouse for customers working under the UK regulatory environment and English law, and provides services tailored to non-US market practices. Again, it's a very significant departure and a very significant move for the CME Group. Though we're a global company, we know that we best serve local needs by continuing to develop our local presence. This means actively participating in the community, maintaining our long-term relationships, while also getting to know the potential new customers that exist in those areas. CME Europe is just the latest example. For decades, we've looked at untapped opportunities across the world and have participated in the community via strategic partnerships with exchanges around the world. I'm just going to give you one last piece of that commercial, if you will, so forgive me. But I want to just talk to you, briefly tell you about the strategic relationships that we do have, that we have developed, and that we think is important. And it's what I'm really kind of getting to in terms of exporting your technology, exporting your R&D, exporting your skill sets and selling those and marketing those and taking those to the market, exporting your skill sets in terms of dealing with governments and how to establish those markets. We've established partnerships with Bursa Malaysia Derivatives in Kuala Lumpur. We've taken a 50% stake in the Dubai Mercantile Exchange. We have cross-listing and stake ownership with BM and Vespa in Brazil, as well as the Mexican Derivatives Exchange and the National Stock Exchange of India. We also have strategic partnerships on a technology and/or product sharing basis with the Johannesburg Stock Exchange and the Osaka Securities Exchange, as well as Korea. This reflects the shift in global dynamics. As we looked at the market about 6, 7 years ago, we did not think cross-border was doable at that time, but we felt strategic relationships were far more palatable on a global basis with many of our partners. And so far that's proven to be quite successful. It also reflects the can't even say that. It shows how we're all together in the global economy today between developed and developing economies. In conclusion, derivatives are a critical tool for market participants across the globe as they help companies manage and transfer risk. This makes it critically important that we all work together. Regulators, market participants, exchanges, and government, to carve a plan forward for businesses in any part of the world to manage the risk on those exchanges. It manifests itself through capital commitment, continued infrastructure development, R&D, job growth, and ultimately helping to provide and assist with creating a healthy economy. We're now witnessing the metamorphosis within the emerging markets of that world, as you can see that coming to fruition. As you can see the emerging markets becoming extraordinarily sophisticated relative to the exchanges that they're bringing on par and the products and the way they look at those products. It's true we're faced with a unique blend of challenges today, but with the challenges come new opportunities to offer effective price discovery and risk management solutions. Our industry has a long history of emerging from challenging times, both stronger and more necessary than ever. I believe that this is happening again right now. Thank you very much for your time. I appreciate it.